Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, July 27th, 5:09 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market continued to be in a bidirectional market correction over the longer term, uptrend over the shorter term, and if we get more of what we got today, we're going to end medium term in a clear uptrend also. Get to that in a minute, but you can see over here the sub arrows. We've gone bullish on three of them. Market leaders still neutral, but after some good news today, good reaction to the Fed, the sub arrow green pointing to bullish. Short term, the weakness, the market shook it off today, pre-Fed and even more after the Fed, to go to bullish uptrend without the red sub arrow underneath, and medium term from neutral to still neutral, but with the green sub arrow being bullish. Long term, we're still under the 200-day moving average, so we're still bearish there. But what happened today? Strong post FOMC move higher, particularly during Jerome Powell's press conference with his statement and the way he answered a couple of questions. The market just accelerated off of a few statements that he made. Now, this happened each of the last two FOMC meetings, only to be undone with strong downtrending Thursdays the day after FOMC. So that's something we're keeping our eye on. But if and compounding, or I should say complicating the issue, is Thursday after the close, we've got two huge impacts to the indices, earnings reactions, namely Apple and Amazon. So we'll see what that brings to the market, the indexes, and to the leadership qualities of stocks, but definitely a good move after the close. We've seen a little bit of weakness in because of two particular earnings reports, Meta and Qualcomm. Qualcomm beat but lowered Q4 guidance. Meta, I don't know what it's down $5, about 3.5%, but I haven't seen details on their numbers, but the reaction is what actually matters. So we're down a little bit after hours, but these are some strong numbers. As long as we don't completely blow up, and we'll look at the charts tomorrow. As long as we don't completely blow up Thursday and Friday, it'll be all in all a positive week for the market, and we'll see what happens when we come into the next level of resistance. So let's get to that next level of resistance, but first let's take a look at a chart here that explains what we do at Revere. This is a chart of the S&P 500. We do trend following here. Here's a look at late 2021 when the market was, for the most part, in an uptrend. We were participating in uptrends when the market goes higher. This particular November and December timeline, we were going sideways. This is a consolidation. We pull back a little bit during these times. When we start to roll over and the direction of the moving averages starts to roll over, we're getting the heck out of the way. That's what our clients saw us do starting in early to mid-January here. The slope of the lines and the indexes, this is called trend following. We get out of the way when the trend goes bad. People say you can't time the market. You can if you know what you're looking for. The people that say that don't know what to look for. They're basically salesmen that need you to stay in all the time so they can collect your fees for their funds. But anybody that's a client or anybody that's been following us for 2022 is well aware of how defensive we've been. That doesn't mean that we haven't taken some re-entries into the market when it called for it, meaning we're getting above short-term or intermediate-term moving averages, and when they do, we dip a couple toes in the water. If the alligator doesn't come up and bite them off, we continue to wade a little bit deeper. We did a little bit more of that today after getting a little bit defensive yesterday in anticipation of what happened with the Fed. But you can see from this bar right here, that the reaction was positive. Let me blow this up a little bit. You can see a very positive reaction to the Fed. Let's take a look at a 5-minute chart and it'll become obvious. First of all, this was a continuation of a down move. That was Tuesday. Wednesday, we came in and we gapped up. And we trended higher into this 39.82 area before we based, waiting for this. This is the 235 5-minute candle after 2:30 when Jerome Powell came out with the statement. This was really what kicked it off. So the 2 o'clock, you'd only see a little bit of volatility here between 2 to 2:30, and that was because they raised 75 basis points. The statement that came out with it didn't really shock anybody. Just minor moves down, first higher, then lower. Then we based, waited for Powell's statement, and at first we sold off, but then took off to the upside as he was very dovish. He had some great answers to some questions. He said we're not in a recession. He said we're focusing on core PCE. That's important because core PCE excludes food and energy. Now, the person that has to buy food and energy doesn't like to hear that. Excuse me, but the markets like to hear that because PCE core inflation actually dropped on the last CPI number that came out. And if he's focusing his interest rate increases on that number, he's going to get a lot more dovish a lot quicker. He specifically mentioned the headline number versus the core number. And, again, doesn't help Main Street, but at this point it's helping Wall Street. And how can Main Street participate? Well, by riding the market higher, if that's what it's going to do. And that's our interpretation right now. Again, this can all become undone overnight or tomorrow or Friday because there's PCE inflation data coming out on Friday. And if that's negative, the market might give these gains back up. So as always, we'll put our positions on, we'll put our stops in place, the risk reward will be there. And if the risk takes us, if the reward outweighs the risk, we'll continue to go higher, put on more positions. If not, we'll be out and we won't lose any more than where we started during this particular re-entry into the market, as our stops have all been raised high enough to maintain the gains that we've been made during this period here in particular is what I'm talking about since 7/19. So there's the S&P 500. That's the explanation of what we do here at Revere. Let me bring in the tail of the tape. And not much news from a headwind standpoint or from sentiment or the VIX. The fear and greed oddly ticked up to 38 today, even though there was good numbers in the market. But today cemented the bull case. So I've changed the font color to green with the Fed reaction, gotten rid of the yellow arrow on the bear case, which the bears were still holding on, but they could, their claws could come back out Thursday and Friday, but as for right now, with a stronger move up and a higher high, we go with what we see in the charts, not what we think. After hours, I mentioned Meta. Tomorrow we've got Apple and Amazon, mentioned that. So Fed news. Fed hiked 75 basis points. Powell dovish, focus on core inflation, said we're not in a recession, and he pointed to, really he just towed the line of what the White House said you can't say we're in a recession if we're still adding hundreds of thousands of jobs each month, and it's hard to argue with that number, but it's not hard to argue with what people are paying at the grocery store and at the pump. But it is what it is. Pending home sale numbers came out. They were not good, down 8.6% in June, down 20% year over year. I mentioned Thursday we've got Q2 GDP. Friday we've got PCE inflation numbers. Not a lot of people are talking about this, but it could play a critical role. So as far as support and resistance coming into today on the indexes, we blew through the resistance with strength in both cases on the S&P 500 and the NASDAQ 100. Good sign there. Tech led, solar's led, and we've got really a new leading stock in the market right now. We'll talk about that. And wasn't in the 21-21. It has been in prior weeks. Got shaken out last week, but it reasserted itself today. And the fact that you see tan here might give you a clue to what I'm getting at. Semiconductor strong, software strong, uranium strong. What was weak today? TLT. That just means interest rates are down. TLT, when bond prices are down, interest rates go higher. TLT was down, but the mid and the short term price was higher, which means uh, those yields were down, which makes the spread bigger, which supports that we're not having a recession. Okay, I hope you followed that. Relative strength wise, although all 11 sectors were green, weakness was in the value sectors: staples, utilities, healthcare, and real estate. They were green, but on a relative basis, they lagged, especially utilities. So what we did in house today, I bought XBI Biotech. I've been watching this for a while. Initially thought about taking this breakout here on 720. Glad I didn't, but when it pulled back, it did what we want all pullbacks to do, that is hold the 21-day exponential moving average. And then with it going over yesterday's high, we added a 5% position to that, bringing our exposure to 50%. So that that exposure, that's volatility adjusted beta, is 50%. We still own 20% SSO, and this 5% XBI. XBI really gets a double weighting from our volatility metrics because biotechs are more volatile than the average stock. Basically, XBI is about equivalent to SSO on a volatility basis. But let's bottom line today. Strong post FOMC move higher supports the bull case. Did I read the numbers here? I don't think I did. G6, and we're going to go through the G6 charts here in a moment, up 3.32%. S&P up 2.6, NASDAQ 100 up 4.2, Dow lagged up 1.4, midcaps up 1.9, Russell 2000 up 2.4, global diversified 60/40 stock and bond up 1.5, Grotection in-house up 1.1, and I did not go through, getting all out of order here, did not go through the NASDAQ 100, but you can see the 3-day pullback there. Where did we bounce? Right at the 50 and the 21, the way we needed to. Gap up today, made a higher high. I don't know if we made a new closing high. Let's see, last 307.38, 306.81. Not a new closing high, new intraday high, but not a new closing high. We've got this declining 100-day moving average overhead. Let's see what happens when we get there. That's roughly equivalent to the top of this prior move off the bottom, this 314.56 level. So double layer of resistance there. Let's take a look at the equivalent levels on the S&P 500. You can see the 100-day moving average is below this top of the last time we tried to move off the lows. Remember, this move off the lows included strong participation by energy stocks. This didn't, because energy has been falling while we've been coming off the bottom. That's one of the reasons why the NASDAQ 100, the QQQ, has been outperforming the S&P 500. But that's a good closing bar today. We'll take it on any pullback. Ideally, we hold 4,000. We filled this gap here that I've been talking about at 4017, but certainly we want to hold the 50 and the 21. 21 is going to come up through the 50-day over the next 2 to 3 days. Let's go to the Dow Jones Industrial Average. It was the weakest today, but it's also above its 50-day moving average. You got the 21 coming up through the 50 there. Also, the purple line, the 100 overhead. Let's go to mid-caps, MDY. New closing high after that 3-day pullback. Good stuff. That makes it just look like a handle, and then you get the news, and the news is perceived as good. It takes us higher, but again, all of this can be undone overnight Thursday's reaction during the market. Then you've got Amazon and Apple. Then you've got inflation data on Friday. So I'm not sounding the victory trumpets or anything like that by any means. IWM, small caps, new closing high, also 100-day moving average overhead. Now let's go to the G6 charts to see a reinforcement of what we're looking at. This G6 was something that we started to track very closely to get confirmation before we start putting a lot of money into growth stocks that are acting well. We want to get confirmation that the growth components of the indexes are also acting well. So here's the first component, IWO. This is the growth half of the Russell 2000 coming into the 200-day or the overhead 100-day moving average above the 50 and the 21, and the 21 EMA has crossed above the 50. Check. This looks good. FFTY, this is the IBD Innovator ETF, lagging versus IWO, certainly. One of the reasons for this is that the IBD 50 lags slightly on their rotation out of bad sectors, so they hold some oil on an extended period of time. It's above the 21 and made a new relative high over the last couple of weeks, which is really the key that we're looking here for, that growth stocks are outperforming on this move higher. QQQJ, this is what we'd like to see. 21 crossing over the 50, not quite a new high versus last week, but it moved off of those two bars, the 21 and the 50, so good stuff there. PDP, this is a momentum Dorsey rate ETF. Cleared this high without question today after a nice tight consolidation. ARK-K, this is Kathy Wood. 3 tough days on a pullback. Hasn't made a higher high, but is above the 21 and above the 50, so it survived this most recent pullback. And the sixth component is MDYG, clear high here relative to the high last week, so another confirmation there. And two that aren't actually in the G6, but thinking about adding this one, SLYG. This is the small cap growth 600. It's the S&P 600 small growth. So there's no junk small stocks in here. And when I say junk, I'm talking about stocks that have no earnings, or they lose a lot of money, but they have sales growth, or they're biotechs without earnings. Those are not in the S&P. So this is more of a quality index versus the Russell 2000. You can see the high here. So that's good confirmation there. GK, this is also a growth ETF. Nice candle today too. And SPYG, this is the growth half of the S&P 500. 2150 cross and a nice candle here today too. Let's compare this to SPYV, the value half of the, sorry, it's SPYV, if I could type it correctly. Note the 21 nowhere near crossing over the 50 yet relative to how we're doing in the SPYG. And the relative strength line making lower highs, although price is making higher highs. So that tells me that growth is outperforming, or actually it tells me value is underperforming. Note the higher highs here on the SPYG index. So we are getting some good confirmation that growth is participating in this move up off the bottom. And if we needed any more, let's take a look at these 3 charts here. The first one is the new leading stock that I talked about, Enphase. This is a classic breakout. Here's a double bottom. You could argue that this is a longer cup with a handle. It had been jagged. We had the mansion shakeout here that I've been talking about on 715. It recovered very nicely from that. But you got the volume and you got the price action today, up 18% on 337% above average volume. Hasn't cleared all-time highs over here from last November before growth stocks peaked. Look at that really brutal sell-off that it had from 282 down to 113. But this is a stock that had a growth blowout, and it's recovering from it. Double bottom base, a little bit of slop here. Nice move up today, even up after hours. Let me verify that that's correct. Yeah, it's up to 260 after hours from a 254 close. So this is one of the 5 charts that I'm going to be looking at to make sure that this rally stays intact. That's number 1. Number 2 is going to be Google. Google, positive reaction to earnings, closed near the highs of the day. We want to make sure that we hold these gains. Quite simply, we're above the declining 21 and 50-day moving average here, but we don't want to see this fade over the next couple of days, nor do we want to see the Microsoft chart fade. This one struggled a little bit intraday, but closed near the highs of the highs above the 21 and the 50-day moving average. So that's chart number 3. And then the other 2 are going to be Apple and Amazon. Apple has been the leader of the big 7. during this move off the bottom. Let's see how we react tomorrow for earnings. And then chart number 5 is Amazon. And above its 50 and its 21, showing a little bit of subtle relative strength with higher highs here. And I said 5, but there's actually 6, and the 6th is Tesla here, which did not break below the lows of the gap up day and had a good day today right into this 100-day moving average. Let's see how that holds up. It does have more recent overhead resistance here from March and April. So those are the 6 charts I'm going to be keeping an eye on. If I had to take a look at some other charts that I want to take some indicators from, NVIDIA bounced nicely off the 50 and the 21-day moving average here. Note the lower volume on the pullbacks on those 3 days, and then the higher volume today, and the 3 days of higher volume when we were coming back up through the 21 and the 50 for the first time today. So this is another one I'm going to be keeping a close eye on. In fact, I want to set an alert right now while I'm thinking of it, above last week's high. So those are going to be the keys to see if this rally continues to move higher. If those charts look good, I'm going to expect the growth charts to continue to act well, and I'm going to expect the 21 over 21 list to start looking a lot better also. I did mention how we sold Celsius yesterday when it broke below this area. That was really me wanting to reduce risk. There was no technical reason to sell that. It was the second inside day. It responded with an outside positive move to the upside today, but we haven't seen any volume on this, and that's something I really don't like. In fact, on the 21 over 20 list, 21 over 21 list, only one stock had above average volume today. That was Qualcomm, and Qualcomm is down after hours, as I mentioned. Let's take a look at that very quickly. Qualcomm here, right at the 200-day moving average, down 2.5%, reduced their Q4 guidance. That's never good. 54% EPS growth is good. Kind of a little bit surprised that they reduced their guidance, but doesn't matter if I'm surprised or not. All that matters is price and volume. And then let's look at Meta here, the other one. After hours, that chart not so good. It's a laggard of the core 7. The core 7 are the 7 biggest stocks in the NASDAQ 100. They just really are responsible for moving the indexes, quite frankly, here. So Meta's been a laggard for a while. They are fully committed to this metaverse. I'm not going to be surprised at all if one of these earnings reports we see a big gap up like we did back in July of 2013 when they became first profitable on their mobile platform, and it led the stock to a huge move. And that's kind of what it would look like. This, what Enphase did today, and that's why this chart's going to be key. We don't want to see these gains given up. This is the move was actually much higher. I think it was closer to 40% on Facebook that day, and the volume was higher also than plus 337. But we always talk about in growth stock circles about stocks having their Facebook moment. And while we're thinking about it, let's just go ahead and look at this. We're going to go back to July of 2013, and this is what I'm talking about. Big move up. It was 29.6% on 749% average volume. July 25th, 2013. Facebook was just another stock at that point. That changed everything. Let's move this to 2015 and go to a weekly chart, and you can see what Facebook did after this big move up. This is the yearbook picture that we're looking for, familiar faces. This is the big move up, July of 2013. Facebook from there went from 34 up to 100 over the next 2 weeks, or next 2 years, sorry. And look at the relative strength line. Yeah, there were some bases and some dips and some secondary offering in there, but look how the relative strength continued to trickle up along with the price action. So that's one of the hallmarks of a big winner, is getting this big move up on an event. It's like an inflection point. Something changes with it, and this stock quickly ran up. It closed that day at $34, nearly doubled over the next 3 months, of a high of 55 to a high of 55. Those are the types of gains that you can get in good, strong growth stocks in an uptrend in a bull market. And I say bull market, it wasn't even a roaring bull market at that point. You can see the market taking a dip in here. This is a line of the S&P 500, market taking a dip here while Facebook continued to power higher. That's why the relative strength line is as steep as it was. So those are the kind of things that we look for when we're looking for the next big growth winners. And that is going to wrap today's video. As always, love to hear from you. Email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. Wrapping up Wednesday, July 27th. This is Don Vandenbord telling it like it is, reminding you it's not how much you make, it's how much you keep. Good signs from the reaction post-Fed today. Let's see if we can keep them Thursday and Friday, and that should clarify things. Thanks for listening, and have a great day.